Confident the Congress will deliver to my desk both the bipartisan physical infrastructure plan and the Build Back Better plan.
Let's talk now about that budget that President Biden is rolling out. As I mentioned, the price tag is a whopper. $6 trillion represents the highest level of federal spending since the Second World War.
Come on, Charlie Brown. I'll hold the ball and you kick it.
Tonight, a potentially fatal blow to President Biden's massive social spending and climate plan.
This is a no.
Senator Joe Manchin, a Democratic holdout for months over the size and scope of the package, closing the door on the $1.7 trillion bill in its current form.
This time I'm gonna kick that football clear to the moon!
Is the largest American jobs investment since World War II.
It's big, yes. It's bold, yes. And we can get it done.
This is a $6 trillion 22 budget, but overall, if you take a look, we're looking at about $5 trillion in additional spending over the course of a decade. That's because they're plussing up in a lot of different areas as a result of the American jobs and the families plans under the Biden administration.
It's not the president, it's the staff. And they drove some things and they put some things out that were absolutely inexcusable. They know what it is, and that's it.
We got to fight. You know, it's so crazy to see this reality where this is done. Unless they do something, this is done. And
that this thing is dead. And it's a great time to take a postmortem on it, because what killed this bill was actually a inflation print of north of 5.5%.
We want our money back, and we're going to get it. And that's why I'm proposing a financial crisis responsibility fee to be imposed on major financial firms until the American people are fully compensated for the extraordinary assistance they provided to Wall Street.
It's because these problems are solvable, but you don't get a sense that we're moving in Washington with the sense of urgency that's required.
If these companies are in good enough shape to afford massive bonuses, they are surely in good enough shape to afford paying back every penny to taxpayers.
What laws were broken?
That's the same Goldman Sachs that since 2009 has been hit with $8 billion of fines for mortgage fraud and other violations. But Gary had it partly right. None of the major Wall Street CEOs were indicted, let alone jailed. Their firms paid fines as a cost of doing business, a simple tax write-off. Without undergoing real reform, they would eventually thrive as they bought back their own stock. Compensation among the top Wall Street executives has soared. The American people did not share in a real recovery.
Oh, come on, Charlie Brown. No. I'll hold it steady. No. Please. You just want me to come running up to kick that ball so you can pull it away and see me land flat on my back and kill myself. This time you can trust me. See? Here's a signed document.
Treasury will purchase preferred stock in each of the banks represented in this room. That stock will yield 5% the first 5 years, 9% after that. We give you money, you lend it out.
Some of us don't need any capital.
You all need capital.
In 2009, the Obama administration responded to the home mortgage financial crisis in two ways: by providing hundreds of billions of dollars of bailout, rescue money, to investment banks to protect them from failure. That was not enough. The second step taken by the Federal Reserve was to radically increase the money supply by use of a monetary tool called quantitative easing.
One of those tools is called quantitative easing, or QE. QE is a tool used by central banks to provide liquidity and keep money moving through the economy. In the United States, the Fed has typically done this by purchasing securities like longer-term treasuries and mortgage-backed securities on the open market. The intent is to keep rates lower and help lenders find investors.
But then, after the crash of '08, between 2008 and 2014, the Fed prints $3.5 trillion. So that's 3.5 centuries worth of money printing in a few short years. Now, that money is not a neutral force. When the Fed creates new dollars, it doesn't create them in the checking account of normal people, right? It creates new dollars specifically, and by design, it creates new dollars on Wall Street in the bank accounts of 24 select institutions.
Quantitative easing means printing money to buy bad assets and buy treasury bonds and securities from banks to make the banks richer. On top of all the bailouts already provided for their rescue.
Quantitative easing, did it actually manage to achieve what it was supposed to achieve?
Well, that's an interesting question. It is loaded because we normally think that it was intended to help Main Street, to help workers and to help small businesses and so forth. But in fact, there's a lot of evidence that at least the initial rounds of quantitative easing were primarily intended to help the banks. Recover from the crisis. What happened was that what we call QE fatigue set in. That is, it was becoming clear that QE was not really helping much of the economy. That the only sector that it was really helping were the big banks.
The aim is to encourage investors to leave safe assets like government bonds and invest in riskier assets like shares. And it's also to stimulate lending in the economy by keeping interest rates low.
But the stimulus was never for the people, never until the end, until the pandemic in 2020. And so wages stayed flat, incomes stayed flat. And most Americans were trying for more than 10 years to make up to the point financially where we were just before the 2008 crash that we didn't cause. Politicians and experts began warning of inflation from the moment that Obama and the Federal Reserve began using stimulus money to try to revive the U.S. economy after the crash of 2008. For years, the warning was preventative. That is, the inflation is not here yet, but it will come because of all that stimulus money. And from 2008 and 2021, the inflation never came. Trillions of dollars of stimulus were applied, but no inflation.
The other concern I should mention is that inflation is very, very low, which you think is a good thing, and normally is a good thing, but we're getting awfully close to the range where prices would actually start falling.
Falling prices lead to falling wages. It lets the steam out of the economy, and you start spiraling downward.
Exactly.
That's deflation, and that's what happened in the Great Depression.
First, did this injection of money mean that the 9 million borrowers did not lose their homes after the 2008 crash? Answer, no. Second, did this $4.5 trillion stimulate the U.S. economy overall, as in at the level of working people, like improving wages or reducing personal debt? Answer, no. And by the way, the U.S. unemployment average, 8% all of those years that the Fed was shoveling stimulus trillions into big banks. So this was not to boost up ordinary people. What did those big banks do with that $4.5 trillion? They didn't share it with us. Ordinary Americans began to get their pennies of stimulus from the government in late 2020. And it wasn't much, a little over $2 trillion over 2 years, divided up 300 million ways, as in 300 million citizens. Compared to the $4.5 trillion divided up 24 ways, that is, a mere 24 banks splitting $4.5 trillion between 2008 and 2014.
We give you money, you lend it out.
Some of us don't need any capital.
You all need capital.
As you may have heard yesterday, the U.S. added 431,000 jobs in March, bringing unemployment down to 3.6%. That's a pandemic-era low.
Be running victory laps. Look, 11 straight months of 400,000 plus jobs created. That's the best clip, I think, since the end of the Great Depression.
But it was we, the ordinary citizens, who got some stimulus, and boom, that's when the inflation finally came.
If I said we're definitely going to have inflation, you wouldn't need me to tell you what to do. Everybody would know what to do. Get some gold, get some land, get some hard assets, hunker down, take a little leverage if you like, and then make a lot of money.
Once that genie of inflation gets out of the bottle, it's hard to get it back in. We're just in a heck of a mess here. And if we pass Bill back better, it's going to be like throwing kerosene on a tire fire.
So I think, you know, we're in a situation where we need to pull back and stop spending so much on stimulus and focus on the long-term economic growth.
The whole financial system quakes and totters. Men are sitting in the parks all day long, out of work, muttering to themselves.
I mean, I spoke to a guest this morning. She says the risk of inflation is very low.
Yes, traders are not so much a focus on the inflation, but on the deflation theme
We had put a lid on the economy last year, hence the deflation winning last year. But now the economy is slowly opening up. That lid is being slowly removed, and now we're seeing the forces of inflation come back into play, like the steam being released from a pot when you lift the lid. Okay? So this is what's happening right now. We're seeing rising prices. We're seeing inflation winning for the moment, for this year, and potentially perhaps until next year. Where I essentially said that the forces of deflation are likely to win in the very near future. In fact, in a book that was published by Robert Prechter, one of the greatest chart analysts out there, in his book, Conquering the Crash, he argues that in the very near future, we're going to see deflation winning, not inflation, as everybody else seems to think.
Our inflation right now is caused by the fact that the federal government is spending and borrowing breathtaking amounts of money.
And inflation hit a 3-decade high in October.
We're now in the grips of an inflation scare.
Between the prices at the pump and even the price you're paying for local groceries, inflation is at a 40-year high right now.
Overall, and certainly terrible policy at a time when inflation is so high and we have such a big debt and deficit. So, look, I don't think we should be raising taxes on the economy, and I don't think we should be doing the stimulus spending. And
Businesses, don't tell me, Jay Powell, that inflation's transitory.
The most serious problem that our nation has is inflation, and it's getting worse.
Everyone is talking about inflation.
Inflation. Inflation.
If you remember nothing from this, remember one thing. If you print money and hand it out, drop it from helicopters, as Friedman said, you will get inflation.
The current Federal Reserve Board keeps track of this supply in a publicly available dataset. See the sharp uptick in 2020? This money went directly into the hands of actual people who spent it, saved it, or invested the funds. That creates a fierce rush of demand, The current Federal Reserve Board keeps track of this supply in a publicly available dataset. See the sharp uptick in 2020? This money went directly into the hands of actual people who spent it, saved it, or invested the funds. See the sharp uptick in 2020? This money went directly into the hands of actual people who spent it, saved it, or invested the funds. That creates a fierce rush of demand.
If you print money and hand it out, drop it from helicopters, as Friedman said, you will get inflation.
Now, did ordinary Americans lose any personal wealth as a result of the 2008 crash? In fact, of course, many Americans lost thousands, $20,000, $30,000, $50,000 and more. How quickly do you think an average worker can bring back a loss of $50,000? It takes years. So when people got those stimulus checks in 2020, this did not allow them to suddenly live large.
Right now.
Well, you mentioned wages. Let's talk about that. We said they're growing slowly. We said how little it was last month, 2% a year. The Brookings Institution says right now almost 2/3 of American households earn less money today than they did in 2002. How do you explain that to me? So is this a structural problem? Because we've been hearing for some time the wages are going to come, the wages are going to come, but they're still not coming. And
the issue of the stubborn growth of wages is not simply an issue that's a function of the Great Recession. This has been a problem and a challenge for literally 30 years.
The major banks are racking up profits in the billions. Wall Street bonuses are climbing back up to where they were. And yet lending to small businesses actually declined in the third quarter. Why is that?
A lot of small businesses are not seeking credit because, because their business is not doing well, because the economy is slow. Others are not qualifying for credit, maybe because the value of their property has gone down. But some also can't meet the terms and conditions that banks are setting.
Is this a case of banks that were eager to take risks that ruin the economy being now unwilling to take risks to support the recovery?
We want them to take risks, but not excessive risks. We want to go for a happy medium. I think banks are back in the business of lending, but they have not yet come back to the level of confidence that, or overconfidence that they had prior to the crisis.
In the start of the new year, 18 states and 19 cities raised their minimum wage. But the federal minimum wage has stayed at $7.25 an hour since 2009, despite some attempts to change it.
So, right now, there is a bill before Congress that would boost America's minimum wage to $10.10 an hour. It's easy to remember, 10-10. 10-10.
That bill never passed, which begs the question, it's been 9 years. What's keeping the federal minimum wage stagnant?
Some of the unintended consequences can be?
Sure. Well, in 2016, we actually did an analysis of this, and it looked at it. If we had doubled the minimum wage to $15, which is what Senator Sanders is calling for, across the country, you would see about 7 million lower wage jobs actually go away. So while some people might get a raise, a lot of people would actually lose their jobs. And look, when you look at companies like Walmart, maybe compare that to Amazon, large companies can take on those kind of higher costs much better than smaller companies.
Next Sunday, June 16th, will mark an unfortunate milestone. It'll be the longest period of time between federal minimum wages in U.S. history since we created a minimum wage in 1938. It was last increased in July of 2009. So there's millions of American workers that have gone now 9 years without actually 10 years without a pay increase. And let's think about what that means. If you're earning $7.25 an hour, which is what the minimum wage is, for a family of two, you are living in poverty. It's one of the reasons why the Fed survey recently found that 40% of Americans can't come up with $400 for an emergency expense.
This weekend, it will mark 13 years since the last time the federal minimum wage was raised. So it stayed stagnant at $7.25 an hour since 2009. So this is making it the longest run without a new federal minimum wage increase in our history.
All right, the federal minimum wage has gone unchanged for 13 years. It currently sits at $7.25 an hour, and with inflation up, many workers are struggling to keep up and just make ends meet.
Raising the minimum wage to $15 an hour would actually boost economic growth by increasing the wages of an estimated 17 million Americans, who in turn will have more money to spend in their communities, which generates more economic growth.
Today, the federal minimum wage is a poverty wage.
Last thing we need are more one-size-fits-all Washington mandates.
It could eliminate up to 3.7 million jobs.
It would lift 1.3 million Americans out of poverty.
Raise the wage for 33 million people, a quarter of the workforce.
Those wages are only available if you get hired.
Working people are doing their jobs. Let us do ours.
Look at this period. Starting in 1997, the minimum wage sat at $5.15 an hour for 10 years. Then it was raised in 2007 to $7.25 by 2009. Imagine how much smoother that could all go if the minimum wage just kind of went up over time. Well, we don't have to imagine it. In France, they automatically raise their minimum wage every single year. They tie it to inflation and the average salary of a French worker. In Australia, a commission reviews the minimum wage every year, considering economic factors like inflation. The UK also has a commission made up of union, business, and economic experts. The Czech Republic's commission consults with employer and union representatives. Their line is lower overall than America's, but it still trends upwards.
Record job growth, higher wages. Too many families are struggling to keep up with their bills. Inflation is robbing them of gains they thought otherwise they would be able to feel. One way to fight inflation is to drive down wages and make Americans poorer. I think I have a better idea to fight inflation. Lower your costs, not your wages.
And financial talking heads and the politicians then announce that our little pandemic stimulus money caused the inflation. And the experts want us to believe that ordinary people caused the inflation because we drove up prices. Because we were so fat on our stimulus money that we wanted to buy goods and would pay anything to get them. And what have the experts said is the cure for the inflation?
Well, Federal Reserve Chair Jerome Powell didn't sugarcoat it, warning consumers that they should expect some pain and job losses as the Fed continues its fight against red-hot inflation.
And I'd like to see it come in a little bit more, even more than that. It'd be, really ideal if the unfilled positions evaporate, unemployment rises just a little bit. We're at 3.5, maybe goes up to 4. That'll take some steam out of the labor market, get wage growth down. And
you say that the price pressures that we're seeing right now is all about pandemic profiteering.
What we see is across sectors, across companies, CEOs are just crowing about how they can raise prices on consumers, all while bringing in record profits. And that's really the root of a lot of the price increases that we've been seeing over recent periods.
This data left year-over-year real average weekly earnings at negative 3.9% and real year-over-year average hourly earnings at negative 3%.
The sectors where we're seeing the highest price increases are not the sectors where wages are actually going up. So wages don't seem to be a driver at all with the current price increases.
Now, most U.S. companies are recording their largest profits since 1950, at least over the last 2 quarters.
That wage growth is slowing, but it's slowing to and stabilizing at an elevated level. It's still much higher than it was this time last year. So wages are not likely pushing up inflation, but it may keep inflation prolonged at the current level. And what we're hearing from our clients, especially our small business clients, is that it's still a tough time finding qualified workers, especially in consumer-facing industries like restaurants.
When it comes to wages, in the lower tiered income bracket, it was interesting to see kind of them coming out ahead and seeing the largest gains. We've talked a lot about the need to hire in some of those hourly worker fronts. I mean, what do you see there in terms of maybe how some of the wage growth is keeping up with inflation and what it means for the strength of the U.S. consumer?
Well, at the lower end of the labor market, we're really dealing with temporarily tight labor markets. And so it's really a temporary sort of mirage that we're seeing right now. And, the strong inflation is going to erode some of those gains. And, that's not great news for the workers who aren't getting wage hikes.
According to the Fed chair, Jay Powell, we have to bring down inflation from 7% a year to 2% a year. Raising the number of unemployed Americans from 3.6%, which is the lowest number that it's been in years, up to 5 or 6%. Because of our pandemic stimulus money, remember the $2,000 check? We have too much in savings now.
According to this chart, what is the biggest driver of inflation during the pandemic? The dark blue is the recent period.
It would be corporate profits.
And what is that percentage?
It is 54%, and that number does stay that level of high if you update that number to more recent numbers as well.
So over half of the increased prices people are paying are coming from increases in corporate profits.
Yes, the unit price index is reflected in corporate profits as opposed to other costs.
And how does that compare to historically to other periods of inflation or over other periods of economic time?
As reflected there in other analysis, it is significantly higher in this recovery, 11.5%.
And what is it today?
53%.
So I want to make sure everyone in America understands this chart. What is a unit labor cost?
The cost, wages and associated work costs.
So we could just wages. What is a non-labor input cost?
A variety of things, including maintenance and investments.
Okay, so I have to buy the stuff to make the widget. I have to have a factory. I have to keep the lights on. I have to hire someone to make the widget. That's this stuff. And this is what I add on top.
When you look at what causes inflation, there are basically three things: labor costs, and then there's non-labor inputs like your overhead, and then there's profits. And there was a recent report done by the Economic Policy Institute, I believe, showing that over half of what's driving inflation have been driven by fatter corporate profits. The markups that companies are taking, whether it's soup or whether it's other items that they're selling.
That some firms are able to somewhat opportunistically raise prices in the midst of all this chaos, given those other two factors.
Greedflation.
Greedflation.
Mike Konzel is an economist at the Roosevelt Institute. In a new study, he graphed corporate profit margins over time.
Their big profit margin has gone from about 5% over the last several decades to almost 10% in the past 2 years. So there's been a giant jump in corporate profits essentially during the pandemic and during the recovery.
We have been so far unable to get any of these companies with record profits to speak to us for this story.
I'm shocked. I'm shocked.
Robert Reich is a professor at Berkeley and was labor secretary in the Clinton administration. What would they say their rationale is for raising prices unduly at a time when we can least afford it?
Well, they would say our obligation is to our shareholders. And that's it.
So everyone agrees corporations have raised prices as high as they can get away with. But not everyone agrees that there's anything wrong with that.
The problem is that Americans are running out of savings. Americans built up this huge pile of savings during the pandemic because of the lockdowns where they couldn't go out and spend money on vacations and stuff. $2.7 trillion of savings was developed over the pandemic.
One thing that's very important in the current environment is that households throughout the pandemic had a very high level of savings. So that means that when savings are very high and cash holdings in checking accounts are very high, that means that we need first, quote unquote, to run down those savings before interest rates increases from the Fed are going to bite. So in that sense,
and today we are talking about the U.S. personal savings rate. It has absolutely fallen off of a cliff. And this is especially concerning considering the fact that it had spiked to a monstrous historic levels on the backs of the stimulus. Take a look with me at this chart. This is Liz Ann Saunders on Twitter posted this chart recently. This is the U.S. personal savings as a percent of disposable personal income, which is important here. So we can take a look here, and the last time that it was this low was back in 2013. Now, this is an impressive decline in the U.S. personal savings rate, specifically because of this massive spike. Now, this is an impressive decline in the U.S. personal savings rate, specifically because of this massive spike. Everybody remembers the stimulus checks. Many people refinanced their homes and basically cut their expenses because they got their mortgage lower. Many people were able to do cash out refinances as well, so they got a massive inflow of cash into their savings accounts. But we've seen the savings just drop and plummet, fall off of a cliff here. The question is why?
Inflation is one of, if not the biggest concerns right now, and the spike in inflation has been made worse by the fact that wage inflation has not been keeping up. Wage growth has slowed in recent months as inflation keeps cutting into consumers' paychecks across the country. Workers are facing cuts in their real pay, with seemingly no prospect of wages catching up with headline inflation. This, despite the fact that unemployment is very low. Though nominal wages have increased, real earnings, which are earnings that have inflation factored in, have been decreasing, meaning that workers are earning slightly less on average now than they were just a month ago, and much less than they were this time last year. Wages have actually grown at a slow pace since the global financial crisis back in 07-08. Real wages sank in the years right after the crises, and although they were able to increase again on the back of very low inflation from 2012 onwards, they only returned to 2008 levels very recently.
The Federal Reserve wants you to lose your job, but not for the reasons that you may expect. What we have seen in the United States of America over the last 3 years is that we are experiencing very high inflation. Actually, it's historic inflation. We haven't seen inflation this high for over 40 years. But in order to get inflation under control, the Federal Reserve for a year now has been talking about destroying demand. When they say destroying demand, that means they want you to stop spending money at stores, buying goods and services, and they want you to stop investing.
It's the way it is. That's the script. And that's why we need to anticipate exactly what the Fed wants, particularly the hawks on the Fed. Unfortunately, there's one word of what they really want. They want pain. Specifically, they want to stamp out wage growth. And that hasn't happened yet. They want people to stop making more money or even outright maybe even make less money.
Doesn't the Fed, Larry, have to push people out of jobs? I mean, right now, everyone is earning money and able to pay up as much as they need to for goods and services. But in order to bring inflation down, they're going to need unemployment at 4.5%, 5.5%. I don't know.
That's probably somewhere in the 5% range. And I think we do have to achieve some meaningful amount of disinflation. So I've said that I'd be surprised if we get to the 6%, get to the 2% inflation target without an unemployment rate that approaches or exceeds 6%. And
in order to achieve reasonable prosperity for 94% of Americans, 6% of the people have to be kicked out of their jobs. If the U.S. achieves 100% employment, this will cause inflation and destroy the economy. So 6% of the American workers have to be sacrificed in order that the other 94% of the Americans can enjoy some prosperity. This is American capitalism.
So what are we waiting for? Let's get this done. We all know we've got to make changes.